So AMC stock has been obliterated over 2022, and many investors hoping for the mother of all short squeezing to happen, well, it simply just didn't happen. It seems now investors have to wait till 2023 to find out if this company has what it takes to bounce back and give any kind of return. In this video, I'm going to have a deep dive into the financials, look at some of the aspects with this business and see if it's got what it takes to survive, recover, and maybe even offer investors a potential return. So here we are at Stock MVP. We're going to go over and look at AMC. Now, this company, of course, is a controversial stock, so if you are invested in it and hoping for a short squeeze, well, this video might not be for you because we're actually going to look at the financials. So, AMC stock, the short interest, as we know, is quite high, nearly 20%. We also know that the company is trading downwards, currently with a 2.7 billion market cap, and the trading volume is around about 28 million, which would need to increase significantly if this stock is indeed to rebound. Many people believe that this company, as it stands, is just solely a potential short squeeze play, but I actually think the company itself might have a better business model than people are giving credit for. Now, as we know, they own loads of cinemas, and their CEO, Adam Aron, in my opinion, has done very well keeping the company afloat in tough financial markets during the last couple of years. They offer a 0.19% dividend. You'd want to go and do some research on that because I believe that might just actually be the dividend they give in form of the ape shares, I think they were called, or something along them lines, which also coincidentally have crashed into the pits of hell. Now, Stock MVP, the reason why I love the software and the reason why I helped create it was because of these, the cards. And believe it or not, here's a fun fact for the future. AMC stock is one of the sole reasons I actually started looking into creating Stock MVP because of this. The cards, the whole idea is these are fully customizable. You can click what is important to you, and then you can create what's called a Stock MVP profile. Now, these are my personal cards, and the reason is they are a simple look into a business with what is most important to you, so that you can get a rough feel for the business and whether or not you want to look further. When the AMC stock was in the midst of its run-in, I had a friend, we were drinking a beer, and he said that he's investing into this company, and I said, it's got tough years ahead. Everything was sort of just coming out of lockdown. There was a backlog of movies that hadn't been made, and this company had some serious problems. But by the time I went through the financials, he was already interested by a butterfly over in the corner. So I wanted to create software that can instantly give me a yes or no if there's a gun pointed at my head. So, AMC, we know the revenues have been beaten up over the last 5 years. Actually, I'll be straight with you, I was expecting this minus 15 to be a lot worse over a 5-year period. 3-year is 28%, and as we know, their year-on-year is up because, well, they didn't make any revenue the year before last. The net income is also up, so we sort of have to disregard that a little bit, and the free cash flow is also up too. If we look down to the shares outstanding, this is where I have a problem. During the last year or so, they started diluting investors. In fact, 400% dilution in 3 years. If you don't know what dilution is, it's basically where a company sells shares at the market, at a fixed price, sometimes just at the actual market price. So what it means is if you bought AMC stock at $1, and let's say you bought, I don't know, 5% of the business, if they've just diluted the business by 400%, well, basically it means your 5% ownership of the business is now worth around about 1. In essence, it just means there's more shares on the market and you own less. Not good for long-term value investors. But again, this is a short squeeze play. Now, the quick ratio, which is a ratio that sort of values the overall business in terms of how much solvency it's got, is 4.9. Now, this is pretty bad. Actually, it's very, very bad. You want this number to be around about 1. And what this is basically doing is seeing how good this company can offset its liabilities. This business has got some liabilities it simply cannot cover. But out of this 50% near coverage, 42% of it is in physical cash or short-term assets. So they can pay off all their debts, 42% of it in cash, which is reasonably okay. Usually I like something over 0.5 as a rule, but typically closer to 1 is better. The net profit margin is down at 19.6. Of course, they're not profitable, so there is no price to free cash flow, because there is no cash flow yet, and there is no PE ratio. You've got all the financials here if you want to go and look at that. At this point, I would not be looking further typically, but since we're doing a video, we will. Now, we have the news. Obviously, we're not that interested in that because we are looking at the financials. This is the problem with AMC. Now, the whole movement of apes and all this short squeeze potential, this is why I'm not buying into it. So, this is the insider tab. So, we can see what everybody has been doing. I'm just going to put this in calendar date. And we can see this is actually not a bad sign. A lot of institutions have been increasing ownership. If we go back to 2014, they have been steadily increasing, albeit from the peak of this insider ownership, 179 million shares were owned around about the end of March, at the end of the first quarter this year. And now that number has fell to 136. That's actually quite a significant decline. Now, that might be because a lot of hedge funds and insiders were looking to play the short squeeze too, and many might be looking to take profit. But this is the biggest problem. This is the biggest problem going on. There's been a big misconception that retail owning this business and they control it is a good thing. It's not, because they will dilute you and you can't really do anything about it, just sort of have to accept it. When a big institution owns a lot of a business, they have sometimes ownership votes so they can vote against dilution and things of the sort. Because there's so many AMC investors, the chance of you being able to block something that the board can do is, well, it's near impossible. As we know, Adam Aarons basically said, we're going to dilute you. And I think a majority of people actually voted in favor of it, which is madness in itself. Of course, we know why. The business would have went bankrupt otherwise. But yeah, 73% retail investor ownership, which is pretty damn horrific. 26% is institutionally owned, and again, 90% is shorted. So I'd love to compare those figures if there was only a tool that could do that, and that is coming, by the way, very soon. So anyway, Vanguard owns 9.53%, which Vanguard owns everything. That's understandable, and BlackRock 4. Yeah, so I'd like to see these figures if it was a long play to be much higher. And they're not. I mean, most companies can own around about 10% as a maximum in terms of big holders and institutions. But I mean, Vanguard owns, yeah, I'd expect this to be a lot more. Let's just say that. The analyst ratings, I don't really hold much weight to this. I know they're going to be really bad, but don't hold much weight. Analysts have anal in their title. They mean absolutely jack. Now, if we go over to the DCF model, which is by far our most popular tool, we can get a 5-year outlook for how AMC will perform. Now, there's a few assumptions we have to make here, and I'm going to do a conservative and an aggressive outlook. Now, first things first, we need to think of an EBITDA. It's all over the place. We have to make some concrete assumptions. Let's do the conservative look first. But I do want to be fair. Now, if we go down to the financial statement and look at the income quarterly, we'll see the EBITDA here at the bottom. Now, this is the trailing 12 months of, what is that, 46. I'm going to put in 58, which was the last quarter. And I'm going to times that by, what was it? Times it by 4, which is 4 quarters equaling a year, which would give us an EBITDA growth rate, assuming they continue the trend, of 232 million in EBITDA, which would give us 232 million in EBITDA. Now, click populate, and then we'll see the future outlooks for EBITDA. Now, of course, these numbers need to change because this is going off next year's assumptions. So this will be 2023, 2024, all the way up to 2028. That is the outlook. We're at the end of the year. Of course, it makes sense. Now, depreciation and amortization, we need to go over to the cash flow statement and do the exact same thing again. Now, depreciation and amortization is here. 147, 97, 90. So let's do the same thing again. 147 times 4, which is, wow, $500 million. 588. Okay, we populate. I'm just clicking 10 for now. We'll come to that in a minute. Now, the capital expenditure is probably one of the most important things you need to put in. The capital expenditure is funds used by the company to acquire, upgrade, maintain physical assets such as property, plants, buildings, tech, or equipment. Now, who knows what AMC is going to do here? I'm sure a lot of theaters need a refurbishment. I'm sure there'll be a lot of acquisition potential as well for companies like Cineworld in the UK, but let's see how this plays out in the future. We have to make some form of assumption. Their capital expenditure is here somewhere. There it is. So that's 38. Okay. Yeah, let's use that 38 times 4. 38. I mean, they did have a good quarter, actually, it seems, in the last reporting. Times 452. So let's put that in here. 152, 1, 2, 3. Now we need to make some assumptions. Now, I think the EBITDA growth rate of 10% is pretty harsh because there's more movies coming out. People are going to cinemas, but moreover, some of their competition has died off. So I think even if they do reach this goal next year, I think they could do better. So I'm going to be aggressive. I'm going to put in a 15%. Again, this is my conservative assumption. The problem with the depreciation and amortization is, as you can see, they already had an overly good quarter. So I don't think they're going to get to $500 million in depreciation and amortization. And what I mean by that is if we look at the annual, the annual here of depreciation and amortization, they never got to $1 billion since 2010. So I think that's probably going to increase by, or maybe stay flat, to be honest. I'm probably going to just keep that at 0. So then it just stays the same all the way through. Because maybe I should actually go negative here, but I'm going to keep it as it is. The CapEx growth rate, they are going to need to spend money. I'm going to put this at 15% and click populate. And all of these numbers now have been populated. The long-term growth rate. Now, this is going to massively affect your valuation. If you're bullish, you can go up to 4. If you're not so bullish, you can go 2, 3, 1, whatever you want. I'm going to go with 2 because, again, in 5 years' time, I think that that's probably where you're going to be looking at, unless they bring out a streaming service which can really compete with Disney, in which case we need to increase the capital expenditure. But let's just go on our assumptions right now. Now, it is a higher risk play, so I'm going to give it an 12% discount rate. We'll keep with that. And if we click calculate here, we then have an assumption. Now, these factors considered, bearing in mind they are my conservative assumptions, going off fundamentals, we see that AMC is currently overvalued by 50%, meaning it's going to go to $2.65, meaning at $2.65, that's where this business should be in relative terms, assuming the assumptions for the future. Hope that makes sense. Again, this is a conservative outlook. Don't be triggered down in the comments. Now, let's be a little bit more aggressive. Let's say their depreciation and amortization increases by 2. Let's go 25 on their EBITDA growth rate. I think that's too insane. I'm going to keep their CapEx there, though. The long-term growth rate, let's put that at 4, and then let's click calculate. If you do that, then it's undervalued by 38%. But here's the problem. Even though it looks like it's undervalued here, a 4% long-term growth rate, I think, is just unachievable in 5 years' time for a cinema chain, unless things massively change. I also think if you're going on an EBITDA growth rate of 25%, you need to increase this probably to around about 35, 40, in which case then our aggressive assumption does this. Long-term growth rate, calculate. Yeah, we did change that, which means that it's undervalued by 14%. And the reality is, again, I don't think this 4% is real. If we go back to in the middle, 3, calculate, we're pretty much flat. So if you think, let's say it like this, if you think AMC is a good buy at this price, fundamentally speaking, you need an EBITDA growth rate for the next 5 years, 25% every single year for the next 5 years, a depreciation and amortization of 2%, a capital expenditure of 20%, you need a long-term growth rate of 3%, and you have a safety margin of 12. So these assumptions, in my opinion, are absolutely insane. I don't think they're going to get anywhere close to that. So just be careful out there. That's my thoughts on AMC. Let me know your price predictions down in the comments. And if you want to check out this software, it is available for you down on the pinned comment. There's currently a coupon code Christmas25, all one word, not case sensitive, and you'll get a 25% discount going forward for the rest of the time you are subscribed. Go and check it out down on the pinned comment.